Okay, I'm over here at finance.yahoo.com and we're just going to search for Tesla. We're going to look at their balance sheet here. You can type in their name or start typing in their name or just put in their ticker symbol TSLA. That'll get you there. So we'll go to Tesla and you'll see a quote here for Tesla and the summary and everything. And I want to direct your attention to this ribbon along here. There's lots of great different things underneath this ribbon. And to find the financial statements, like balance sheets, income statements, all that, we're going to go under financials here. And then we're going to go to balance sheet. You got income statement, balance sheet, and cash flow. So we want to look at the balance sheet in this section here. So let's take a look at balance sheet. And you'll see this is the balance sheet for Tesla. And you can look at it either on an annual basis or a quarterly basis. It defaults to annual here. Oops, sorry about that. And so you can see it's got the different years here. Again, balance sheets are looking at a moment in time and a specific moment in time. So that's unlike where you might have, let's say, quarterly numbers for an income statement or a cash flow where they're adding up. These are all individual kind of statements of time. So you can see total assets are higher at this moment in time than the previous two periods. But let's say we want to look at quarterly. We want to see more recent performance. So we can look at a quarterly balance sheet, what the moment in time looks like in the more recent last, 4 quarters, basically. And again, these don't add up. See how these don't add up? They're all their individual numbers. Again, different than income statement or cash flow where they would add up to, let's say, the last 12 months. So here we are at a quarterly balance sheet. And if your first thing is to look at, let's say, your total assets, you can see this number here, 57,834,000. One thing that's important is the numbers are all in thousands. So you'd want to add 3 zeros when you're looking at any of these numbers. So this is not 57 million, this is 57 billion, because we're going to be 57,834,000 and then adding in thousands another 000. See, these are in billions. So if you're looking at a smaller company, it might be in millions, but either way, you're going to be adding in that number. So this is 57.8 billion. And the big 3 buckets you'll want to look at is these 3: total assets, total liabilities, and total equity. And we'll go through each of these in detail. Everything beyond here is, it can vary on Yahoo depending on different companies, is kind of pulling from these big 3 buckets and giving you maybe information or calling it out more. Like total debt, for example, they're just calling it out versus having you go find it in under total liabilities, for example. So let's go through each of these big 3 buckets that you want to look at. And you want to look at to see if what might be trending. How are things going? Our total assets are things, as you'll see, things like cash as an asset. Is the total number going up or going down or staying about the same? And you can see it's gone up a little bit. And total liabilities, which are things that we owe money on, like paying our debts, those have stayed the same, maybe gone up a little bit too. But really, what you'll look down to is what's happening inside these. And then we'll break down what each component is under total assets. Because it's one thing to know total assets, for example, but what are the different components? So in total assets, you have current assets and non-current assets, basically. Current assets are anything that's happening within a year. So it's the key number there is happening within 1 year, or you can liquidate it within 1 year or sell something like, or you can get things like cash, for example, within 1 year. And total non-current assets would be things that might be, you wouldn't sell or take advantage of within a year. So that'll be the same for total liabilities. You have current liabilities, again, things that are happening within a year. You got to pay a bill within a year, versus total non-current liabilities, which might be like long-term debt that you don't have to pay for, 2, 3, 10 years out in advance. But we'll get to that one. So let's start with current assets. So what composes current assets? We got these down arrows. You can learn more stuff about what's going on under each of the arrows. So we know that Tesla in the last quarter has $25 billion of current assets. Of that $25 billion, $16 billion is cash and cash equivalents. Cash is super liquid, right? It's stuff that you've got right now. You think of your own checking account or your own bank. If you have cash, you can go buy stuff with it. And a cash equivalent is something that's as similar to cash. So if you look at Tesla, you'd say, well, this is pretty good. They've got $16 billion of their total current assets is in cash. That's very, very good, very liquid. And all that's really in cash and cash equivalents. They have some other short-term investments. Maybe they're investing in a short-term bond ETF, for example, and that's 30, not 1,000, that's 30 million. Remember, it's in thousands. So 16 billion, almost all of that is in cash and really accessible cash equivalents. So that's a good thing, you'd say, on this. Receivables are things like accounts receivable. That's usually what you'll see here. Is just, you won't see other breakdowns. They'll say accounts receivable or AR. That's what people owe you money, right? So if you bought a Tesla car and you put it on your credit card, Tesla would be owed that money. You didn't pay for it in cash. So they're waiting for money to come that they'll turn into cash once those receivables are paid. Now, some people don't pay their receivables, right? They don't pay their bills, right? So that's money that's not as readily accessible as, let's say, cash. But it's money that they're counting on coming in. And that's 1.9 billion, right? Now, something that is current that they can turn over within a year is inventory. And you can see that's a big number too. Now, what kind of inventory would Tesla have? Well, I'm sure you're thinking, well, they have cars, right? Until they sell a car, it's part of their inventory. So you can see they've got $5.1 billion in inventory. Companies like manufacturers would have larger inventory balances here under current assets. Maybe retailers would have a large inventory as they sell through their inventory of soap or groceries, food, whatever it might be. A software company, for example, like maybe like a Facebook, or it's now called Meta, would not have large amounts of inventory because everything's digital. Now, in inventory, you can even break that down further. Again, there's zero. So we click on that, and you can see inventory is basically broken up into 3 buckets: raw material, work in progress, and finished goods. So if we think working backwards, well, a finished good would be the car is done. If that brand new Tesla Model 3 is rolled off the line and is headed to the dealership ready to be sold. Work in progress means they're in the process of finishing that good. It's still in process. And then raw materials would be just the basic raw materials. It might be, something like metal or rubber, for example. Now, Tesla probably is buying their tires from somebody else, but let's use it as an example that rubber would be a raw material. Putting the rubber on, on a tire would be a work in progress. And then putting that tire and completing the car would be a finished good. A finished good is something that's now sellable. Work in progress means it's kind of in process, and raw material is basic raw materials. And so you can see that $5.1 billion inventory, you can see how those numbers change. And if we were to look at their finished goods, you could say, well, back in December, they had a lot of finished goods, and that number is going down a little bit, and more is going into raw materials and work in process. So if there's let's say delays and maybe some, if it's let's say GM or Ford where they have unions and then they're on strike, you might have a lot of finished goods sitting around or not being done because they haven't turned those raw materials into work in progress. And then other inventory is just other inventories of things that are not, part of that, maybe part of their main line. Maybe it's inventories of solar panels, things of that also, or batteries that Tesla might sell to other people, for example. So that's our current assets, right? We've got all these main buckets of cash, money that we're owed in terms of receivables, and then also inventory. Also in current is prepaid assets. Basically, you paid in advance for something. So it would be kind of like a prepaid asset, so it's paid in advance. So those are our current assets. Now, those are, again, things that you can turn into money basically within a year. Cash is already a year. You're expecting your receivables to come in within a year. Inventory you're expecting to sell and turn into cash in a year when somebody buys a car. Non-current would be things that, again, are big over a year. And you can see that's a pretty big number too. That's 32 billion of non-current assets. So what's in here? So one of the biggest areas for companies is PPE. Now, you might know PPE from the pandemic, which is personal protective equipment, like face shields, for example. But that's not what we're talking about when we talk about on a balance sheet. PPE is plant, property, and equipment. Sometimes I get that backwards. But basically, plant, property, and equipment. And you have your net, which would be your net property and equipment. So if you break that further, you've got your gross. So you can see that those two numbers for Tesla are very similar, right? Their gross and their net, or net after adjustments, is pretty close to being the same, 30 billion versus 36 billion. But if we dig deeper into gross, we're going to see some adjustments to that gross to get to our bottom line net for property, plant, and equipment. So what are some things you have under here? You've got land, right, where their factories are, and they own those land, and they've improved that land. They own buildings, things like that would probably fall under here. They have machinery like robots and other types of welding equipment and things, furniture, that kind of stuff, where the offices where Elon Musk sits. They have a lot of money in machinery. These are assets. They're worth something. Assets are things that are worth something. And then they have other properties that might not be related to the core of their properties, and then they have construction that's in process. It's not completed, but it's in process, so there's still value there. So that would be an asset, for example. And you have leases, right? So they're accumulating their leases, and they paid off. This is leases kind of paid off on their leases. So these are all assets. Again, things of value. Now, where you write off an asset, that's depreciation, right? Things, depreciate or get worse over time. That brand new factory you built, for example, is not as valuable maybe over time. Now, some things like land and factories may go up in time, but let's say machinery would be a good example where that welding machine, starts wearing out over time, and you can depreciate that or reduce its value, and you want to account for that. So that's where they have accumulated depreciation. You can see how much the depreciation, and that's your difference. Look at that 6.2 billion. If our gross was at 36.7 billion, if we take out depreciation of 6.2, now we're at 30.5, approximately, pretty much that's what we're at. So that's where our net property, plant, equipment as a total non-current asset comes in. And that'll usually be the bulk of your non-current assets. Now, there are other ones that are in there like goodwill and other intangibles. And you can see they've got some for Tesla. Some companies like Coca-Cola has a lot of goodwill. And really what goodwill is all about is things that are hard to quantify. Things like when you have a merger or an acquisition, the difference in the value, which you can kind of quantify versus buying a company. But also things like in there, like goodwill would be things like branding. Tesla has a strong brand. Coca-Cola has a strong brand, and so they're accounting for that under goodwill. Is it as tangible as like a finished car as part of, or a work in progress or a rubber or things like that? No, it's not as tangible. So you want to consider that when you're valuing companies. And then there's other intangible, assets that might not fall under goodwill. This is where you might need to go to the company's, income statements and annual reports and things to get, if you really want to know super deep, like what are they counting as intangible assets. So that's under there. And then also other non-current assets fall in here. Again, Yahoo will give you a nice, good summary stuff, lots of good information. But if you want really fine detail, you'll have to go to the company website and look at their income statements, or their balance sheet, where they'll get into the detail. But right now, we can see that, the total non-current assets, the bulk of it is what we expect in property, plant, and equipment. So this is our assets, right? So these are good things. These are our assets. These are things that are worth something. Now, we owe money, too. We owe things, and that's where we have our total liabilities. And so if we look at total liabilities, that's where you have your same current liabilities, things that are due within a year, and non-current liabilities. This is a good number to look at too. Like, is most of our stuff due soon, or is most of it due later? And you also would like, and this is what, like, where you get ratios and things like for investors, like a current ratio. A current ratio is looking at current assets, divided by current liabilities. So in effect, 25 billion versus divided by 18 billion. And you can see that number would be above 1. It'd be, 1 point something. And you want your current ratio to be above 1.0. That means they have enough current assets, things like cash and accounts receivable coming in, to pay their current liabilities. So current liabilities, very much a mirror of current assets. Let's go into there. So we had accounts receivable. We also have accounts payable, or accrued expenses, or AP, accounts payable. This is money that we owe to other people. So if we're buying tires that are completely finished from Firestone or Goodyear, another company, that we're going to stick on our cars, our Tesla cars, we owe them money. We buy it on credit. So that's an account payable. So that's money we owe. We have to pay within a year, usually even sooner than that, 12.6 million. And other types of, like, current provisions or other types of current things that we owe money on. Or current debt. If we go in here, you can see I'll break it up with current payables and accrued expenses, that we're basically accounting for those expenses. But another thing is current debt, right? So this is debt that's coming due. So we have things that we owe as far as we'll pay our suppliers, the tire company, but then we have debt. Maybe we borrowed money, we issued a bond, or we borrowed money from the bank and we need to pay our debts. So that's where current debt would come into. And you can see how they might have current debt, like for lease obligations or other current borrowings. So we owe money on our leases, or we owe money to the bank, or maybe we issued a bond and we owe money to our bond holders. Either way, this is money that's currently coming due within a year. And then if we look under here, we also have current deferred liabilities. So we've deferred some liabilities, we've deferred paying things, but now they're coming due. So now we have to pay the money within a year, so now we owe money. So really the key thing under current liabilities is to think of that big thing as being all within a year, right? Everything's coming due within a year, and we want that to be, ideally less than our current assets so we can pay those bills within that. And then also be looking at how things are going, right? If we see, oh, our current payables are going up, but maybe that's because our current assets are going up because we're getting more cash in because we're selling a lot of cars, not a big deal. Then if, let's say we have current debt really rising, then we might be like, oh, all our long-term debt's coming due. We have to be able to pay that or maybe restructure our debt. But if we go back in time, we can see it's actually going down over time. That's a good sign as far as current debt would be. So we have our total liabilities is made up of current liabilities, and now we also have total non-current liabilities, or things that are due over a year from now. And a lot of that could be like debt and things and long-term provisions, as a kind of a catch-all bucket. But what you'll mostly see is long-term debt and lease obligations. We owe money on if we're leasing out factories. We owe money on things that we borrowed that might be a 3, 5, 10-year type of bank loan or debt. So if we look under here, we can see how that's broken up between lease arrangements and debt, for example, money that we owe. So this is stuff that's not coming due now, but it's something we're going to have to pay in the future. Again, a good sign. Going back in time, they're at 10.8 in long-term debt, and now they've been paying that down and are down to 8 billion, right? This is where you can look at things like cash flow statement and income statement to see, is the money coming in that'll help pay for this, basically. And then you have non-current deferred liabilities. So this is non-current, and this is kind of like, again, you'd have to go to the website or to their detailed one to really look in these in great detail. But things like tax liabilities, taxes that we owe that might not be current or coming due soon, or current deferred revenue. Maybe we've deferred these taxes or we deferred that revenue. This is a little deeper accounting stuff, but either way we're not realizing this type of things coming in a year is basically what's happening. Preferred securities, other non-current liabilities, this is all things that fall into that long-term provision bucket. So again, liabilities, just like assets, are made up of current assets, liabilities, and current liabilities and non-current liabilities. The magic number is 1 year. If you take these two numbers, the 57.8 billion and the 29.9 billion, the difference between total assets and total liabilities, that is your total equity, or your total equity and gross minority interest, but really that's your total equity. That's what's left over. That's what goes to us stockholders. This is the value of the company, basically saying, okay, our company, essentially is one way of looking at it. There's other ways of looking at it, but you could say, okay, we have, a total equity of 27.8 billion. Again, we'd like to see that number go up, and it has. So that's why one reason Tesla stock does well is they're continuing as a growth company. If we break that out, most of that's going to be in stockholder equity, right? We own stock. Now, there's some minority interests and different things too, but you can see it's such a smaller number compared to that 27 billion of stockholder equity compared to 836 million. That makes up that total would be 27.889. If we dig a little deeper, you can see that almost all that is capital and things that's money that's been raised by selling stock, basically. And then there's retained earnings and losses and different things that affect that number. These different gains, losses that affect that number. But basically, you're looking at that total that net stockholder equity as part of that total equity, right? And then you adjust a little bit for minority interest. But again, this is common where 27 billion of that, of the 27.8 billion, is in what we have as stockholder equity. And the key is that's the difference between assets and liabilities. So these two numbers will then, assets minus liabilities will equal equity. These three are the big three you want to look at. And then this is just all extra stuff that kind of highlighted or automatically pulled by Yahoo Finance, or some things that some people really like to look at. One thing that people like to look at is working capital, right? You might hear the term working capital. And again, you can just kind of see where the numbers go. You can really start adjusting that number a little bit, but working capital is looking at your current assets. Simply, it's your current assets minus your current liabilities, right? So we can see our liabilities, have been going, our current liabilities, let's go back to that, have been going up. See how the current liabilities have been going up. So because our current liabilities have been going up and our current assets have stayed the same or gone down a little bit, if we look at our working capital, we can see that reflected, going down from 12.4 billion to 6.9 billion. We'll call it maybe 7 billion. So those are just another ways of interpreting the numbers in the big three categories you want to look at, in here. This is just pulling out more numbers for there. And things like total debt and all that, that's just coming right off. If you were to dig deeper, they're just into total liabilities, you can find your total debt. They're just kind of pulling these numbers out so you can find it real quickly. Things like tangible book value is an interesting thing too, where people look at like the price of a stock to its book value, or P to B. Well, what is the tangible book value? What is the company kind of worth? You look at your total assets minus your total liabilities, which is that stockholder equity. That's part of the total book value calculation. And then that 27.8 billion is adjusted down a little bit further by intangible assets and that goodwill. Remember, that goodwill was kind of this kind of branding, a little bit more of an intangible number, just like intangible assets are intangible numbers. They're not as hard a number. So if you want to say, well, I don't want to look at that total gross equity, that's nice, but I want to pull out those, I don't want to say made up, but a little bit more estimated type numbers. You don't know what a branding is worth until you sell the company, for example. Well, that's where I can get to my tangible book value and take out intangible assets and goodwill, and I could say, so for the hard type stuff, the real tangible stuff, company's really worth, as far as a book value, 26 billion. And is that number going up? Yes, it is quite a bit over the last quarter. So there you go. And that's a good sign, again, versus a company whose tangible value would be going down. So there you have it. That's the balance sheet, as far as looking at the balance sheet and the key things within there that you can start digging into that. And it's things that come off the balance sheet that are used in things like ratios and other things that investors would use to evaluate a company. So the key is your assets and your liabilities, and the difference between the two is your total equity, which you're pretty much are looking at total stockholder equity, or things, if we're an investor, what we get to keep. Okay, I'm at finance.yahoo.com here. We're going to look up Tesla, and we're going to look up their income statement. You can just type in the name or their ticker if you know it, TSLA. So I'm just going to go to Tesla, and you'll see their quote here, and you'll see this ribbon with lots of good information here that you can find in this ribbon. And we're going to go to financials, right? This is where they keep things like the income statement, the balance sheet, and the cash flow statement. You scroll up here a little bit, and you can see it'll tend to default to the income statement, but if you want to go to the balance sheet or the cash flow statement, you just need to click on those. And with that, you can look at your income statement on both an annual basis or a quarterly basis. That's where you hear things like quarterly earnings. There's a quarterly earnings announcement. That's where that is coming from, as far as their quarterly reporting. But if you look at an annual, you can see income statements are also things that have happened in the past. They're basically kind of report cardy type stuff of how things are going. So if we look at that, you can see going back in time. But if you want something a little bit more sooner, you'd want to go to quarterly. Oh, by the way, if you see something that says TTM, that means trailing 12 months. So this is looking back over the last year. If we're looking at an income statement over the last trailing 12 months or last year. But let's say we want to look at quarterly. So I'm just going to click on quarterly. That changes our numbers here because we're now looking at quarters. The other thing, too, to keep in mind is that all the numbers are in thousands. So what that means is we look at total revenue, and we're concentrating on this trailing 12-month number here. Total revenue for Tesla was, over the last year, 46.8 billion. And the reason it's billion, not million, it looks like million, that's where the number's in thousands. It's basically a way to make the column smaller, because it's 47,864,8,000, and then another 000 to make it into thousands. So this is billions, 46,848,000,000. Now, one thing with the income statement is, especially when you're looking at the quarterly income statement, is these numbers, looking at the past 4 quarters, add up to the trailing 12 months, right? 4 quarters in a year, or trailing 12 months. So if you look at, anytime you're looking at these numbers, you can see how they add up. But it's good to sometimes look at these numbers to kind of look for trends and things. Is our total revenue going down? Revenue being, and we're going to get into that in a second here, being sales, like money coming in is revenue, right? So we want money coming in. Is our money going up as far as coming in? Or is it going down? Are we struggling? So if we look at the last 4 quarters, we can see that each quarter, well, a little bit, we went 10.7 billion, 10.3, then we jumped up to 11.9, and then in September really jumped to 13.7. So you can see some pretty good trends as far as over the last year. Sometimes with companies, they have seasonality. If you're a retailer, for example, and you sell clothes or you sell toys, you're going to sell a lot more, let's say, over a holiday time or a big gift-giving time, like Christmas time, than you would maybe in the middle of the year. Same thing, let's say you sell boats, right? You're going to sell a lot of boats early in the spring for people to use through the summer. Maybe you won't sell as many boats in the winter climates when it's snowing. Okay, so these numbers add up to that number. So let's concentrate on the trailing 12-month number here. So first thing you want to look at for our income and what our goal of our income statement is, it's going to show us what is our earnings. How much money did we make? That's the big question it's asking. Did we make money or did we lose money? So first thing, as far as making money, you want to have money coming in. You want people to buy your goods and services. That's total revenue. You could actually call this total sales if you wanted to, and that would be perfectly fine. And then again, with these down arrows, you can see more detail. So we know our total revenue is $46.8 billion for Tesla, but does this give us a little bit more insight on where that money's coming from? In this case, it doesn't, because it's all coming from operating revenue. If we had revenue coming from other sources or unusual sources, it might list it out here. But operating revenue is basically the core of the business. What does Tesla do? They sell cars. If Tesla also sold consulting services, they might break that down. Look at maybe like an Amazon, where you have e-commerce and you have Amazon Web Services, and they get a lot of revenue from both. Or Apple, where they get money from their hardware products like cell phones, but they also get money from software things like the App Store. So they might break that out more. But Tesla, they're pretty much they don't break it down. They're getting all their money from revenue. Now, again, on the website, they might they'll give you more breakdowns as far as what models of cars might be selling better than others. But for right now, for this type of summary stuff for an income statement, we can say our total revenue is $46.8 billion. Cost of revenue, well, you got to pay the piper, as they say, right? So it costs money to make a car, right? And that's a variable cost, right? Those costs can go, kind of up and down as far as, the variability of the costs of a car. Maybe you're buying tires for that car that you're going to put on the car, and you buy those tires from Firestone or Goodrich or some tire manufacturer. That's a cost of revenue, or, historically it was kind of termed like COGS, or cost of goods sold. So that can be a more variable number, and it really is in relation to your total revenue. And you'll see, going backwards, that there's always a cost of revenue. There's always a cost to sell something, to make that product or support that service. So if you take your total revenue and you take out the cost to basically generate that revenue, the net is your gross profit between these two numbers. 46.8 billion minus 36 billion gives us 10.8 billion. Now that's our gross profit. We still have more things that eat away at our profits. But right now we can say, hey, when we sell cars as Tesla, we made over the last 12 months 10.8 billion just selling cars. But that's not the whole story, right? Is that our total profit? No. It's our gross profit. It's not our net profit, because there's other expenses. And you could probably look ahead and see, all right, there is other expenses. So other expenses took out 6 billion, quite a bit, right? And that brings us down to our other income. The difference between these two numbers is income, right? But before we get to that, let's take a look deeper. Like, what are these other expenses? We already have expenses here to make these cars. What are these other expenses that seem so big, just eating at our profits? So let's click down and see what they are. One of the biggest expenses out there that people have, all companies will have, is what's called SG&A. Can you guess what SG&A stands for? I'm sure you did. It's selling, general, and administrative expense. So the costs that are more, they can vary whether you're hiring more people or those types of things, but they tend to be more fixed costs, or they tend to be more, costs that are not involved in making the car, right? These are selling, general, and administrative expenses. So the costs around, hiring accountants or hiring marketing people, that is an administrative expense. So you don't need marketing people to make a car. You do need marketing people to help sell cars. So that's a big part of your thing is your SG&A. And you can look and see how are they managing their SG&A? Is it going up? Is it going down? Is it pretty steady? Generally, it's pretty steady here for Tesla, which is not a bad thing considering that their revenue is going up so dramatically that they're able to keep their SG&A a little bit under control here, right? As far as if you look at each quarter. And then the other big number that you'll see typically under operating expenses, R&D, or research and development. And you can see Tesla puts a lot of money into R&D, $2.375 billion in research and development. Companies like pharmaceutical companies who are creating new drugs and blockbuster drugs will put a lot of money in research and development. So if Pfizer and Moderna want to make a COVID vaccine, they're going to spend a lot of money in maybe particular quarters for that research and development. So companies are really heavy on innovation or creating new products. You want to see money spent on R&D. If you see their money really going down in R&D, especially if they're a growth-oriented company, take like Tesla or take like Virgin Galactic, involved in space travel. If they're not putting money into developing space travel or building spaceships and better and cheaper and more effective spaceships, then that could be a warning sign that they're cutting their costs in maybe an area they shouldn't. But you can see Tesla has got a good balance here between SG&A and research and development. So that means new cars and new technologies are going to come out that are going to help Tesla drive that top line revenue, those sales, right? All right, so we have sales or revenue. We take out the cost to make that revenue. We have our gross profit. We took out our expenses like R&D and SG&A, selling expenses and things, administrative. And that brings us down to other income. Now we're getting more closer to net income or net profit or pre-tax income, the different ways you can call it. But we're now close to we made $4.48 billion. And we do have some other expenses to adjust that down a little bit more as we get to our more of our bottom line. What's the bottom line income? So that's our income from our operations. By making cars, we've got operating income of this. If we consider all our different types of expenses, we have this income of $4.45 billion over the last 12 months. If we look at net non-operating interest expense, this is expenses and things that are things from interest things. So we have interest income and we have interest expenses. Probably, sometimes it gets funky with the subcategories with Yahoo. That should technically be a negative number. We can tell it's a negative number here because, these are operating expenses. And we can have, technically these expenses should be negative here. We just sometimes have to interpret the overall columns where it kind of mixes it up a little bit. But net operating interest expense, or being a negative number, is we have interest expense here. So what is interest expense? What are we paying interest on as Tesla? Well, we're paying interest maybe on our bank loans. We need to build factories. We need to borrow money. We need to do things. So maybe we're paying money on bank loans, or we've issued bonds, like corporate bonds, to raise money that we need to pay interest on, right? People own our debt. We need to pay them interest on that debt. So that's why that's such a big number, that negative $546 billion. And this would be interest income. So if we are making money, we've invested in, let's say, some bonds or different things, and you can see that's a small number typically will be, but it offsets that bigger interest expense, so they account for that. So basically, we have to pay our debts, right? We have to pay the interest on our debts, and that's money going out, and that's where that 509 reduces that operating income from $4.48 billion, and then you add in other kind of a catch-all categories for special charges and different things that might come in, like here's restructuring, mergers, other non-operating expenses, some big numbers there. Again, you'd have to go to the main site and the main income statement and annual reports and different things like that to get the reasoning behind it. But you can see when it's not as big a number, it might, you can kind of maybe gloss over a little bit. But these are numbers that are taking our almost our bottom line income, operating income, and adjusting it further down to now our pre-tax income. That's what most people consider our net income. What do we have for income that we're going to pay our taxes on? It's just kind of like you're in your own personal, balance sheet, or income statement. You have money coming in for your salary. Maybe you got a bonus and you get money coming in, or you're paid an hourly wage, and then all that money comes in has to go out to pay things like, maybe late fees on credit cards or to buy things, right? So that adjusts your income done. So pre-tax income, Tesla here had $4.087 billion in income. And this is another good one. We're looking at quarterly numbers. Is that number going up, right? And we can see, yes, that number is really going up. And, that's really a great sign. Another great reason why people say Tesla, oh, the Tesla stock's so overvalued. And from a lot of measures, it is overvalued. When you look at price to earnings, different things like that, you're paying a lot for a Tesla stock. But what are you getting for that? You're getting a very definite company that is able to prove and is a leader in the electric vehicle or EV field and generate great income. But you're also getting a company that it's not just sitting on its laurels. They are also doing things like putting money into research and development to keep ahead of the competition and to keep driving that top line revenue and to drive that income and drive those profits, right? So that's stuff that drives stock prices up, is positive earnings and certainly rising earnings and rising earnings in the future. So we have $4.08 billion in pre-tax income. We take out a tax provision. We got to pay money for taxes. This number can be, can really adjust as they start, getting to the final what they're going to pay in taxes. But, so do consider that. But this gets down to the really net income for common stockholders, $3.468 billion. As a stockholder, a common stockholder, this is what we, basically say, hey, this is what we made on my company I own. And, if I own a share of Tesla, I don't own as much as Elon Musk, the CEO and founder of Tesla, but I own a share. That's my net income. And that's, and that's usually be the same here. And there might be adjustments for like minority interest. See, 129 million versus let's call it 6 billion, very small number. But these are things that adjusted as far as for the common stockholders. Or dilution, of that number, they tend to be the same. As you can see, they're exactly the same. Now you do have dilution, where dilution happens is where you have, maybe you've issued more shares of stock or something like that, and that dilutes the current shareholders' shares. So when we look at, again, in the income statement, these are the boxes that you're really looking at. You're trying to go from our total sales, taking out all of our expenses, adjusting things for variable expenses, more selling expense, research and development, adjusting for our taxes, and get to our net income here. This is what we're looking for, our bottom line income as a shareholder. All these other numbers down here, you might see in Yahoo Finance there'll be maybe none here, or maybe there'll be a whole bunch of them. Like this has a whole bunch of them because it's easy for Yahoo to pull, or whatever reason that they pull from these different financial statements. But this is all stuff that's based on everything that's up here. So if you don't see any of these long things afterwards in a stock maybe you're looking at, don't worry about it. It's really just ways of highlighting things that you can look at very quickly. And some things you want to look at quickly, like look, if we look at over each of these different quarters, it's pulled numbers for at least the last 3 quarters for earnings per share. Looking at earnings per, how much net income or earnings are we making per share of stock, right? We want that number certainly to go up. Or if it's diluted, right? You can see how the diluted number's actually gone up here. Now, what dilutes shares of stock? Well, one thing that really primarily dilutes shares of stock is issuing more shares of stock. Again, these are individual numbers, so you can see where they would add up to a trailing 12 months. So you can see Tesla has been issuing shares of stock, the last 3 quarters. Let's go back up here. You can see these are the last 3 quarters, and then this is the 4th quarter looking back in time. So if we look at that earnings per share, nothing changed here looking back 4 quarters. There was no changes. But here we had a change with some dilution because Tesla issued, some shares, right? They issued shares of stocks. And that brings that number down a little bit. And they keep issuing shares of stock, and that keeps bringing that earnings per share because it's diluting it for the current shareholders. But if you bought shares right now, you'd be getting that earnings per share of 1.62. So that's a number you can look at, earnings per share. Another thing that when you're thinking about income statements that a lot of people look at, and again, you can Google or you can look in great detail about all these different things, but 2 that also really stand out is EBIT and EBITDA. EBITDA. I like to call that. Some people would call it EBIT and EBITDA. I like to call EBIT and EBITDA, right? So if we look at the trailing 12 months here, they have 4.6 billion in EBIT, right? So what is EBIT? So it's basically it stands for earnings before interest and taxes, right? So we want to take out some of those numbers to look at, well, what is our earnings from our operations? What are we really earning if we take out things that might skew those earnings, like interest and taxes? because we can maybe do things to lower our interest payments, or maybe we can do things that we can, pay less taxes. So I want to see really more taking those numbers out, and that's where we get that 4.6 billion, because we take those numbers out. EBITDA is basically looking at earnings before interest, tax, which would actually raise that number because we're taking out that, so we actually have more earnings because we're taking out expenses of taxes and interest we're paying. So that number, 4.6 billion, you can see is bigger than our 3.468 billion of net income for common shareholders, because we took out, if we were to go back and look up interest and taxes, we took that number out. So now it's 4.6 billion. EBITDA is the same concept. It's got all the interest before earnings and before interest and taxes. And the DA part is also before depreciation and amortization. Remember we can adjust things with depreciation and amortization. We can depreciate assets. We can depreciate our equipment, which brings up our income if we're depreciating out, or we're basically taking that out of the equation. So that raises that number up if we take out that number by taking out that adjustment for depreciation. So again, it's a higher number, 7.3 billion. So we're really looking at, again, we're taking our earnings and we're making adjustments to that. And these adjustments are things that reduce earnings. And I might have misstated where I said depreciation and all that. depreciation, we're taking that almost as a way of reducing the value of something, so we're taking that out of earnings. But again, as far as actual real earnings, you could look at your car at home that you own, maybe if you own a car, and say, well, I can depreciate that because it's not going to be worth as much in the future, 2 years from now, and I can depreciate that out. And thus, when you sell it, you can sell that automobile for less money because it's a used car now, and you can depreciate even further if it's banged up or rusty or something. So this is just another way of looking at it and say, oh, I like that 3.468 billion. That's great, Tesla. But if we really take out income and taxes and depreciation and amortization, we can see we're actually maybe doing better, right? And if you look at the numbers, at least this one, they have numbers, you can just see how that number is really rising from 625 million to the 4 quarters ago to the most recent quarter of 2 billion, a little over 2 billion to give us our 4.6 billion. So again, with the income statement, these are all things that we're looking at answering that question, did we make money? We did, 3.468 billion over the last 12 months. And you can see we're making money every quarter, right? Balance sheet and cash flow are related to that, so watch the videos on that. But this is the income statement where it really answers that. Are we making money? And are we making money because we're selling more stuff or because we're controlling our expenses? How are we making money? And that's how you can start answering those questions, by looking closely at the income statement. Okay, I'm over here at Yahoo Finance, or finance.yahoo.com. Let's look up Tesla, and we're going to look at their cash flow statement. Again, you can put in the name or the ticker TSLA, and we're going to go to the cash flow statement, and you can see the quote here. You want to look along this ribbon here for all sorts of good information, and we're going to go to financials, is where our financial statements hang out and hide. Basically. And you have income statement, balance sheet, and cash flow. It'll fall to the income statement. So we want cash flow. So we're going to click on cash flow and have that reset there for a second. Let's try that again. There we go. And so here we are at cash flow. You can see that's where it says cash flow. And we can look at our cash flow either on an annual basis, where it typically defaults. You can see these are the different years, or we can look at the last 12 months, the trailing 12 months on that cash flow statement. But let's say we want to look at it quarterly. So I'm just going to click on quarterly, and thus we can see the last 12 months, the trailing 12 months, or we can look at how each quarter has been doing for more recent information. And that's a really good way to look at it, because we want to see how is our cash position being adjusted up or down based on, not only over the years, but also more recently as well. One quick thing too, that all the numbers are in thousands. So if we look at this 9,931,000, that's not 9,900,000 or so. That is actually adding on a comma and 3 more zeros. So it's in thousands. So that is 9.9 billion. 9,931,000,000. This would be 3,147,000,000 and so on. So just remember it's in thousands. So cash flow, again, is all about is money coming in or is money going out in terms of our cash and our cash position. Different than the income statement, which is we're really trying to answer the question of are we making money or losing money? The balance sheet, which is kind of our report card, like what's our current snapshot in time? And then our cash flow is like looking how much cash do we have, in effect cash and cash equivalents in the bank, and what's happening with our cash. Is our cash flowing out or is our cash flowing in? Think of your own bank account. Is your money flowing into your cash, into your bank account from maybe your salary or things like that, and your bank account savings is going up, thus your cash position is going up? Or are you paying out more in terms of like your credit cards or other bills, rent, mortgage, whatever it might be? And how are you doing with that cash flow, going up or positive? In the end, we want our cash flow to be positive, but there's some things we need to spend cash on and we need to buy things. So we'll see negative parts in our cash flow statement too. But in the end, we want to see an ending cash position that is a positive number. As you can see here, both the trailing 12 months and you can see over time, over these last 4 quarters, we have this positive cash position. But how do we get there? And that's where the other big parts coming here is the operating, investing, and financing. This is the key, is these 4 top parts, particularly these 3. And then we'll talk a little bit about this extra stuff, which is kind of a little bit more extra bonus information. But you really want to understand these 3 in particular, because that's going to help you get to your ending cash. So as we know, operating cash is like from our operations. So we're looking at Tesla here. Are we selling cars? When we sell a car, we get money coming in, right? When we make a car, we got money going out, maybe to buy, materials and things. Investing is investing in our business. Are we buying plants and equipment? Or are we selling that stuff off to try to raise cash? Again, this is all about, it's different than the income statement. It's all about what is happening with our cash going in or out. And financing is like related to, investing. Tesla does not pay a dividend, but let's say it was a company that paid a dividend, that means money's going out of our cash because we're using it to pay our shareholders. Or if we're selling stock, to raise money, that would help our cash position because we're basically having money come in. So it's all about the flow of cash. So let's look at these 3 buckets in detail so you can understand it more. So first off, operating cash flow is basically our operations. And you'd want to look at it and say, okay, we have $9.9 billion over the last 12 months for Tesla from their operations in terms of cash coming in. And what does that look over the quarters? Are they all positive? Are some quarters negative, so there's more cash flowing out? And you can see over the different quarters, these are all positive numbers. They're all kind of right around the same, although we had some nice cash things both at the beginning and at the end of these last kind of quarterly periods. So ending up with our operating cash flows. But let's dig deeper into that. How is money kind of happening through there? So this is from operations or continuing operations. We're selling cars, right? So if we look at it, we have cash coming in from net income. That's our profit, right? That's things. So thinking about the the income statement, right? We've got profit coming in. And when we make profits, we've got, cash coming in. After we paid all our operating expenses and things, we've got cash coming in. So that's our net income from continuing operations, is at $3.5 billion. And that can be adjusted by operating gains and losses, right? Maybe we sold some property, plant, equipment, or there's a foreign exchange thing where we have from our operations part of the foreign currency exchange, might be a small number. We'll actually see more foreign currency exchange stuff more inside the financing part of it. But you can sometimes see little numbers in here too. But this is our basic operational gains and losses. Are we operating from an operating standpoint? This is net income coming in, but is there some gains and losses from the operation standpoint? The other thing where we're taking money, basically in or out, is from depreciation and amortization. So you think about depreciation from a cash standpoint, we're depreciating an asset. Maybe we've got equipment, trucks, whatever it might be, and we're depreciating that, saying it's not as valuable. So when we depreciate that from a cash flow standpoint, that's basically, in effect, adding cash to us because we're not having, in effect, think about the cash again flowing, and we're depreciating that asset. We're not buying an asset, we're actually taking a write-off on that, which makes our cash position go up. Later we'll learn about free cash flow, which can be a better number as far as kind of taking that kind of a big number out of it ends up being a big number, which it is for for Tesla. So they're doing a lot of depreciation. But again, this is all about cash coming in, cash coming out. So stock-based compensation or asset impairments, it's that good or bad small number here in relation to the big 9.9 billion for the total number, a smaller number here for asset impairment of our different assets that we might own. Are they being impaired? But here we see a bigger number for stock-based compensation, and you can see how that's being adjusted each quarter. So that means we're taking cash out of the company and we're paying compensation with stock. Think of it like stock options for executives. So when Elon Musk pays himself and there's executive team, for example, stock options or paying stock compensation. So instead of paying a salary, we're going to give you more in a bonus that could be salary, but maybe our bonus is going to be in stock options. Then that's stock-based compensation. That's money going out because we're basically compensating people instead of salary. We're compensating with stocks, and that's adjusting our cash flow. And you can see they pay a lot in stock-based compensation, which you can see a lot in especially growth companies where they pay more around compensation for growing the company to their employees who are getting stock options. And then there's other non-cash items. These are things where you'd want to go to the company's website, look at their detailed income statement to see what might be making up that type of thing. And then change in working capital. Remember if you think of income statement, working capital is looking at our current assets minus our current liabilities, right? So, our change in working capital, we're doing better as far as, current assets going up versus current liabilities. Current assets being things like cash and accounts receivable, those kind of things. And this is where it can get tricky. So let's look a little closer at this one. Change in working capital. So we have change in receivables, right? So a receivable is accounts receivable. You can see it's the same number here. So they could just label this change in accounts receivable. So accounts receivable is where we're receiving money in from people who owe us money. They bought a Tesla on a credit card, or they bought a Tesla and they owe us money, right? So this is the change in the cash position. So if this is a negative number like it is here, that means our account receivables are going up. That means more people owe us money. So in our cash position, we don't have cash coming in from accounts receivable because it's gone up. We have actually cash, in effect, flowing out, is the idea. Versus, let's say, money flowing in like this, looking at this quarter here, we had cash coming in where people are paying their debt to us. They're paying us 135 million, and thus our change. And you can see how these numbers are change. It's the change in accounts receivable. If you were to look at the balance sheet, you'd actually see the raw number of how much money do we have in accounts receivable. This is looking at the change in that. So this is where financial statements can be tied together, where the balance sheet and the cash flow statement are tied together through accounts receivable. Another way, maybe an easier way to look at this, is through change in inventory. So inventory, do we have more completed cars that we own? So this is a value, right? Or do we have less completed cars because maybe we're selling them, right? So we don't have that inventory, or inventory of raw materials or work in progress. Either way, what's happening with our inventory in terms of a financial basis in our operations? And you can see our change in inventory. We have negative 995,000 in cash. What that not thousand, excuse me, million in cash. This is our cash flow out. So that means we're putting more money into building up our inventory than what we're selling in inventory, right? So this is not necessarily bad. That means we're making cars, and if we look at our income statement of things, maybe we're selling more cars, and in order to sell more cars, we need to make more cars. If we look back at the different quarters, you can see these are all negative numbers, but here we had 180,000, or I keep saying that, 180 million, excuse me. So that means our inventory went down in effect, and thus that's changing our cash position. So these are different ways of looking at cash from prepaid assets. Then you have payables, right? So we have payables and changing in our payables. This is money that we owe out, right? So this would reduce our cash position in terms of if we're paying our payables, if we're paying our accounts payable, which would be another company's accounts receivable. If we're paying, then this would be a negative number. This would be adjusting our overall cash position down. We're looking at cash from continuing operations, this bucket. So that's a big number. What does that mean? That means we're not paying as fast on our accounts payable. That, from a company standpoint, that's not a bad thing, because then we can use that money to invest in the company, earn interest in our, a little bit of interest in our bank account. Companies don't want to pay their accounts payable fast. They want to get their accounts receivable in fast, but they want to slow down their accounts payable, and that's why you see positive numbers here, because it's money that we owe. We have to account for that. It's going to reduce our cash position at some point, but right now we're not paying it, so we're kind of retaining that cash. And then you have changes in other current accounts payable, so you'd want to look at that, and this might be a company example where you want to look in more detail on it, at the company's more detailed full income statement and some of their comments that have that. Change in current liabilities. This again was change in current assets, not accounts payable. Change in other current assets. Change in current liabilities. So these are kind of offsets, and then change in other working capital. These are these things that are happening through the income statement, the balance sheet, things that are changing these asset, liability, and working capital combinations. But all these numbers add up, and both positive and negative, to give us this 9.9 billion. Let me go back up here. 9.9 billion in cash flow. That means 9.9 billion over the last 12 months is coming in. And we've adjusted for money that's gone out, or adjusting for that, like money we've sent out for payables, and money that technically in effect has come in because we're holding off paying on accounts payable. A little tricky there, but that's the idea, that you want to really think about this operating cash flow, and we want these to be positive numbers. Are we building our cash numbers by operations? Because a lot of times investing and financing is what's going to reduce this number and reduce our cash position typically. Now investing, think about not us investing as stockholders or working with the stock markets. That's going to come under financing. We're going to look at investing from the company's perspective. Are they investing back in the company? Are we buying things? Are we investing in the company? And as you can see, Tesla does a lot of investing back in its company, to the tune of almost $7 billion. So they're making cash come in by their operations. That's a good sign. By selling cars, they make 9.9 billion. But we need to invest to keep that number going good. We need to keep that net income and our profits going good. So we need to invest in the company. So that's where our investing cash flow is. And over the trailing 12 months, the last 12 months, that's about 7 billion, 69999, right? So let's look a more closer at that by hitting that down arrow and looking at those continuing operations cash flow from investing standpoint. So what are we spending money on to get this big 7 billion? And what we're really spending money on as Tesla is PPE, right? Property, that stands for property, plant, and equipment. So we're buying equipment, we're buying properties, we're building factories, we're investing in the company, to build out more. We want to, maybe build out more factories internationally, for example. So we're going to invest in that. And that takes money, that takes cash, right? So we are investing in that. So let's look at that a little closer. And you can see it's been pretty consistent as far as continuing investing back in property, plant, and equipment. And it doesn't give you the detail as far as what specifically. It might on the website, or you might hear management guidance saying we're building a new factory wherever. Where here it's really just a repeat of the same thing. So we know this is going into property, plant, equipment. We might have to go to the website or to their specific stuff and really dig into the company deeper to see, well, what property, plant, and equipment are they buying? Now, net intangible is just kind of this, intangible stuff or some unusual stuff that's going on versus more traditional stuff of property, plant, and equipment. And if we look at this number over the last trailing 12 months, we can see we had nothing the last 2 quarters, 0. And then we had a big expenditure here, 1.2 billion, and then just a very small expenditure in the quarter before that. So most of it all happened here. And if we click onto that, we can see we purchased something. I'm not sure what intangible thing Tesla purchased, but they bought something for 1.5 trillion to invest, or billion to 1.5 billion to invest in the company. That wasn't part of property, plant, and equipment. It's some type of intangible thing. So maybe it's intellectual property. Maybe it's something that they're investing in the company that they bought in, right? And then they have a sale of something intangible that they're selling, and to offset that a little bit, or maybe they just did an accounting adjustment. So in this case, usually you won't see anything there, but if you see something, it might be a big number pop up. If you're real curious about it, that's where you want to dig in and say, okay, what back in March there did they spend 1.2 billion on? And then you have just kind of this catch-all of net other investing things that are in there. Again, investing is all about investing in the company, and that's going to be investing primarily in property, plant, and equipment. And if it's something different, you want to look into that, like this intangible thing for Tesla. All right, so that's brought our number down, right? Money's flowing out, almost 7 billion flowing out. But the good news is 9.9 billion flowed in. But we saw here under financing cash flow, we had more money flowing out, 1.25 billion flowing out. Money could flow in from financing, by the way, but we have it flowing out. So why is that? And an interesting thing here, if we go back, and we'll explore this further as we dig into this, but we had money flying in, almost 2.7 billion coming in back here in December of this quarter, and then we have money flowing out. But boy, look at all that money coming in, and look, all that operating cash, flow was good, real good, and then we didn't have much in property, plant, equipment. So this was quite quite an interesting quarter here. So what's going on in financing? That we have this big number here of money coming in, but over the last 12 months, we have money going out. That's why it's a negative number, and money being cash. I'm going to click on this. This is just a repeat, so we have to dig a little bit deeper in here. All right, so let's dig in here. Let's dig in on this. So what happened here? So we have net issue payments of debt. So what does that mean? That's our debt, that we're paying our debt. That's a good thing if we pay our debt. We got to pay our debt, and that's the debt number, right? So if we dig deeper, we'd see long-term debt issuance. That means we're taking on more debt, which improves our cash because we're issuing debt. We're issuing a bond. We're selling something that if I give you a bond, to you, in return I'll pay you interest rates for things, but I'm issuing debt and I get money from that debt. Repayment of long-term debt, that's payments, that's the company paying in on their debt. Like if they borrow money from a bank, for example, that they're paying their debts, right? So this is where they're issuing debt, which causes cash to go up because they're getting paid for debt they're giving out. And this is payment of debt of the company paying their debts. And that's typical where you can see this is a much bigger number. Banks might be a little bit different, where banks are really issuing a lot of debt because they're in the issuing of debt business, things like mortgages, stuff like that. So if we look at our net long-term debt, and by the way, this number is going to come up again later on, 9.5 issuance, 6.1 a payment. You'll see that down here when we get to this part, which we'll get there quickly here. You can see where those numbers repeat is just a highlight. They highlight those because you can see it's kind of hard to dig. You have to dig far to find it. All right, so we know the net, and then the net is the difference, between all these numbers, right? The 9.5 versus payment out of 16 billion, that gives us our net of 6.5 out, right? Of payment. Net long-term payment issuance or payment is basically what that should say. So, well, that's great. And it's great that we're paying our debts and things. But wait, what's this here? What's this big number here? And as you can see, where we talked about, where our financing cash flow were popped up here back in that December 2.6 positive versus everything else being negative. And we're wondering, well, where did that come from? Well, we can dig deeper and we can see right now it came from net common stock issuance. Nothing here, nothing here, nothing here. 4.9, almost 5 billion of issuance of stock. That's issuing, and that brings cash into the company. And that popped up that financing there, where the other ones didn't because we were paying our debts. So that's that 4.987 billion in net common stock issuance. So what's going on here? Well, basically Tesla, when they sell stock, when a company offers stock for the very first time, and they go from private to a public company, as you may know, that's an initial public offering, right? They're offering their stock, they're selling their stock to the public. And the reason they sell their stock to the public is when you buy that initial stock offering, that raises money for the company that they can then use to invest in the company in things like property, plant, and equipment, for example, or to pay off shareholders, all sorts of different things they could do with, issuing that, pay off executives and things like that. So, or private investors. So what Tesla did was, boy, our stock was really rising at this period. Look at how much that stock is worth. Let's issue some more stock, and look at and if we do, we'll raise almost 5 billion of stock that we can invest in the company. That's great for the company, by the way. They just got basically $5 billion, but by doing that, they dilute the shares of stock. So if you're an existing shareholder, your stock is worth less, in effect, because they issued all these new shares, right? So that dilutes the shares of stock. So sometimes you'll see stocks drop when they do that. Not too long ago, Virgin Galactic, the space company, issued a bunch of new shares, and their stock dropped 13% in a day because they needed it really more to keep the business afloat than, let's say, Tesla, who's like, I'm just taking advantage of a situation here. And that's what that net common issue in stock is. That's what they did, issue common stock here, right? So if we look at that financing operations, the overall thing ended up being a negative 1.2 billion because we had 6.5 going out in terms of cash going out from along our debt, and then we raised stock, as far as money coming in, and then we had proceeds from stock options and other financing charges to kind of make all these numbers add up and true up, right? So other different more detailed things. So if we look at the three big lines, we did great as far as 9.9 billion over the last 12 months in operating, investing, which is investing back in the company, which is a good thing, but it costs money to do that. That's 7 billion. It can be a good thing, and if it's investing because we've got to pay our debts, that's a different thing, and that's where financing comes in as far as the payment of our debts. So this is investing company. This is basically related to debts and issuance of stock. And we answered our question like, why did this number pop up? And if you look at it, this is probably not going to be a regular occurrence as far as financing cash flow. Well, next year will they issue more stock? They may not, and so that might cause that cash to go down. And that's what this is doing, is we then start getting to some of these other things here, which is, and we really also have no part number to hang in there on, is this free cash flow part, which is our ending cash position. So this, sometimes you might think, well, does these three numbers add up to this? And as you can see, it doesn't, right? It does not add up to the ending cash position. Also, this is a case where the ending cash position is a static number. These four numbers don't equal that number. It's really, this is now where these other categories, these numbers add up to these trailing 12 months. This is a static position answering the question, how much cash do we have on hand? What is our ending cash position? And that should tie out or relate to our balance sheet. When you look in the balance sheet and you look at assets and you look at cash, that's where these numbers will link up. So that's our ending cash position. And you want that number to be obviously positive. They'll usually be positive, but you don't want that number to be going down precipitously. You can see it has been going down a little bit over these last quarters, but a lot of that is because we're investing back in the company, right? So, which has helped growing our operating cash flows and help grow our net profits and things. So that's not a bad thing. It's just what you want to be aware of what's going on there. So if we click on this and we look at our ending cash position, how do we get there? Well, first off, we have to look at our changes in our cash position from the previous period. So since we're looking at the last 12 months, so this is where we'd want to go to an annual number. Remember, we go up here to look at annual. We'd want to look at our annual and look at our cash flow as far as the change from the last 12 months to the previous 12 months before that. That difference will be the changing of the cash position. If you look at it, looking at each quarter, you can see how the change in cash position is happening here. Between these different numbers here, as far as changing in the cash position. That's why these are smaller numbers. See how how this was, we'd have to look at the previous period here, but this was a big jump because we had this big jump in financing and operating cash flow. So, and then we have, and I know this will make a little more sense in just a second. Just hang in there 1 second here on this part. But you can see, if we look at I'm going to drop down here to beginning cash position was 16.8, and because that number ties to the previous quarter, 16.8. So a better way to start would be, we ended our cash position in June here at 16.8 billion. So our beginning cash position, when we're going to adjust for it in September, is 16.8. These are the same exact numbers. And then we adjusted for our change in cash position, basically what's going on up here. And then if there's an exchange rate thing that's impacting that, many international companies that sell a lot of stuff or things that do things internationally, their cash position changes just looking at cash because the exchange rate and the cash changes. The US dollar is not the same in September as it was in June and not the same in March. So they're adjusting for these changes in exchange rates that might be happening. So that 16.8, you adjust for the change in cash and the exchange rate, and that's your new ending cash position, which where the quarter after this will now begin the new beginning ending cash position, just like here 16.8 to there. If we look at 17.7 ending to 17.7, adjusted for the change in cash, bigger number here, and change in exchange rates, now we're at 16.8. So I hope you saw how this static number is a real interesting number of something to look at as far as our changes in our cash position. But these are the three big buckets that you really want to dive into, because these three things is what's influencing that number, that ending cash position change. The rest of the stuff is, you may see on Yahoo Finance, you may not. Depends on the company where they automatically or if they're pulling certain things. Here they're looking at capital expenditure, which is investing in, pulls out some of these hidden numbers, deep buried numbers, pulling off maybe the website and the real specific stuff. Capital expenditure is CapEx, or it might be known as CapEx. That's where they're investing in physical assets. So physical things being capital in terms of, capital assets, property, plant, equipment, things that are physical, but even deeper than what PPE might show under, let's say, investing cash flow. Issuance of capital stock, well, we saw that in our financing thing. This is just calling that out because that's an unusual type thing. You can see that for the last quarters that they didn't issue the capital individual stock. This is not physical stuff. This is actually common stock that you and I can buy. So that got called out. And then this also gets called out because it ties into free cash flow, which is important, which is issuance of debt. Are we issuing debt that's bringing cash in, or are we paying our own debts, which is taking cash out because we're paying our debts? When you pay your credit card, you in effect are paying your debts, right? You're paying your credit card bill. That's repayment of debt, is what's happening there. So free cash flow is looking at things like your operating cash flow less your capital expenditures is what's happening here. And so when you're looking at your debt things, this is where that's called out, so you can kind of see what debt's on. But when free cash flow, which is separate, we're looking at how much free cash does management have to spend on stuff. That basically we're taking out a lot of this financing, a lot of the investing, a lot of the other debt stuff, things that we're obligated on, and say, how much do we have that management should say, hey, go have a good time, go pay you've got $2.5 billion over the last 12 months you can spend on stuff. Here you can see how they arrived at that number, right? We've got free cash flow, positive numbers. Negative free cash flow is not a good thing. It means, hey, you get less money to spend on good stuff. So how does free cash flow, where's that number come from first off? Well, it's basically looking at your operations. This is management, right? We're looking at how are your operations doing? So we're looking at that $9.9 billion over the last 12 months. And then what we're taking out of that is our capital expenditures. That's why it was important to really, without digging, pull out that number that Yahoo provides us for. And the difference, $9.9 billion to call it 7.3, 7.4 billion, with some rounding there, that's our 2.5, right?